Hi, my name is Alex Carlucci with Gus & Show Associates. Another question of the day is, if economic activity slows down, what happens to the market and the housing market? So I was just talking to some people in my office about this. I feel like it's slowing down a little bit. You're seeing some stock market pressure. It's going to be going down this in September of 2021. It's going down quite a bit. It's down 3 or 4%. I think it's going to go down another 6 or 7 for sure. That's a total of 10%. I think maybe even up to 20% correction. So, oh my gosh, what happens? This is what we talked about. So I think what happens is you see the taper talk maybe fade away. This is if this happens. The taper talk will fade away, which means they're probably not going to want to hike rates or stop buying mortgage-backed securities or treasuries because they're going to get proof that there was transitory, the inflation that was causing them to have to do the tapering. So if you see them stop to talk about that taper talk, you're still going to see the government buying treasuries. That's going to help keep rates low. Now, what big traders do, big investors, people with lots and lots of money, they're responsible for the wealthiest people in the world, so they're probably going to start selling their stocks and moving that in a place where it's safe. So the bonds are safe, cash is safe. So you'll see a lot of people buying the treasuries. When they buy treasuries, that drives the rate lower. It's inversely related. So if you see people, the stock market going down and that money going somewhere else, it goes into bonds and they're buying bonds, it drives the rates lower. So if the rates are lower, it's going to keep a bid in the housing market so the house prices don't fall, and it's going to increase the refinances because people can refinance their house for a lower rate, and so the housing market keeps churning, the loans keep going. So the loans always have to keep going, otherwise this country's in trouble. So the banks are looking for rates that will keep business flowing to keep the economy churning. So I keep that in mind. There's checks and balances and functionalities in our system that help fix itself. And yes, the Fed has to step in sometimes, to help save us when the market's not working properly. So hopefully the market works properly, and if the stock market feels a slowdown, everybody sells their stocks, that they buy the bonds, drive the rates down, and keep the housing market going. So if rates are 1% of the 30-year fixed, of course people are going to buy houses. They're not going to stop buying houses because the economy is slowing down. So that's kind of how the economy keeps on trucking and fixing itself with slowdowns and speed. So if it was getting really, really busy and really hot out there and there was no COVID problem, rates would have been way much higher than they are right now because the government stepped in to keep rates low. So it was so busy the last year, the rates should have been much higher to stop that naturally, but the government came in and they bought treasuries. That's called the Fed being involved with the market, and the tapering is for them to remove that. So if they remove that bid, the rates would have gone higher. And because they weren't buying the treasuries, so if they weren't buying the treasuries, the rates would have gone higher, and the housing market would have slowed down naturally. But they kept it low to keep the people buying houses because we needed something in the economy to keep us going through this COVID. The housing market was so busy that it spread out into other industries like furniture stores or painters or construction workers. So it helped keep the economy going when the restaurant people were probably starving and the vacation people were probably starving. The people who run cruise ships are still starving. So at least some part of the economy was booming, and that's why they did it. So I don't expect them to taper right now. I feel an economic slowdown coming. Not brutal. I don't think it's a cliff that we're going to fall off, but I do feel like we're going to slow down a little bit. That was so crazy what we just went through the last 12 months that it can't keep up like that. So I expect it to slow down from that, and you might see some sell-off in the stock market, which you're seeing now. I think a little bit further, and you'll see buying in treasuries, I think, in maybe the 10-year yield going farther down, and maybe some refinances coming in, maybe some new buyers coming in off the street because now they qualify for a home because rates are a little lower. That's how I see the next 4 to 6 months. Don't know, but that's how I see it. That's my guess. Let's see if I'm right. Mark my words. Today, September 19th. I'm not sure what the date is anymore. But give me a call if you got any questions. I'll talk about treasuries all day long. I know them very, very well. My phone number is 630-915-7550, and please subscribe.